Hi, everyone. We are now going to be looking at Chapter 12. Specifically, we will be looking at the risk, the cost of capital, and, sorry, I'm just looking at something, and valuation. Sorry about that. So that's our focus. Let me make sure I'm recording. Good. We don't want that to happen again. Okay. There we go. So we're going to be measuring a firm's cost of equity capital. We're going to really dive in and talk about beta and how the impact it has on determining the firm's cost of equity capital. And then we're going to comprehend and calculate the firm's overall cost of capital and then incorporate flotation costs. Well, that's our outline. We've got quite a few things to get through, right? So let's get to it. So in earlier chapters, when we talked about capital budgeting, we focused on the appropriate size and timing of cash flows. And we discounted them. Well, this chapter, we're going to show you how to determine the appropriate discount rate, especially when cash flows are risky. So I like the very beginning of the chapter, and I just want to point out one or two things on page 357, because we're going to be talking about weighted average cost of capital. And right in the very beginning, where it says the opening case, it says, what exactly is it? And this is really important to remember. It is your minimum return that a company needs to satisfy all people who give them money, all their investors, their stockholders, common stockholders, their bondholders, and their preferred stockholders. So that's the overall return that must be made, the minimum return to keep all of them happy. And then it comes down and it starts our first paragraph. The goal of this chapter is to determine the rate at which cash flows of risky projects are to be discounted. So when we're doing that, we have to look at, and this is important, we'll talk about that picture there, how projects are financed. They're financed with debt, they're financed with equity and other sources. So we have to estimate the cost of all these sources so that we do pick the appropriate rate. So in this chapter, we're going to start with the cost of equity. So what happens here? What are we looking at? Well, because stockholders can reinvest dividends in risky financial assets, the expected return on a capital project should be at least as great as the expected return on that financial asset they're going to go and buy. So firms have a choice with their cash: keep it in and put it into a project, or give it to the shareholder and let them take the money and invest in a financial asset. Okay, so in the end, the return they would get, you can see this arrow coming back around, the return the shareholder would get by buying another asset, so that return on that asset should equal the project investment. That's what we're saying. So I'm still on page 357. I like the way your book really laid this out. So what that diagram before was saying is that we should only take on a project if the expected return is greater than that of those other assets your shareholders will take and invest the money in. So very simply put, first gray box down at the bottom, or brownish box, whatever you want to call that, It says the discount rate of a project should be the expected return on a financial asset of comparable risk, because that's where they're investing those dividends. So just so we know up front, we use some terms synonymously. Required return, okay? Cost of capital, discount rate. They all mean the same thing. So it's the rate we're going to use for the project. So from a firm's perspective, the expected return is the cost of equity capital, and it can be defined as the formulas you see there, where R, absolute RS, is the risk-free rate. So R with a little s is that risk-free rate. I'm sorry, RF, I'm sorry. RS, okay, is the expected return on the stock. So yeah, that's what we're calculating. RF right here is our risk-free rate. I'm like, what am I saying? And we've seen this formula already, plus the beta times the market premium, which would be the return on the market minus the risk-free rate. That's the premium. Okay. So go to page 359 and we'll go through an example there. Suppose the stock of Quatrum Company has a beta of 1.3. The firm is 100% equity financed. So that's the only cost it has related to equity because it's financed by its shareholders. It has no debt. They are considering a number of capital budgeting projects that will double its size. Because these new projects are similar to the firm's existing ones, the average beta is assumed to equal the existing beta because they're similar. The risk-free rate is 5%. What should be the discount rate used to determine the present value of those cash flows on the project? That's what we're really looking at here. Well, the estimated cost of equity would be the risk-free rate plus the risk premium of 8.4% times the beta of 1.3. So 15.92. Now, two things you need to remember. The assumptions in here was that the new project has the same kind of risk as other projects. That's why we used the beta of 1.3. The other consideration here is that all of the firm is financed with equity. There's only one type of item here, equity. So when we're determining the net present value of the future cash flows on this project, we should use the 15.92%. Now, how do we estimate a firm's cost of capital? We need to know three things. Again, we need to know that risk-free rate, the market risk premium, and the company's beta, which was given to us. And that's what this is at the top of page 350. So again, suppose the stock of Stanford Enterprises has a beta of 2.5. The firm is 100% equity financed. That's the key here. Risk-free rate is 5%, and they already give us the market risk premium of 10%. So we plug those amounts into our formula. The required rate of return, the cost of capital, is 30%. So if the project, when we're determining the net present value, we would use a 30% discount rate. Now suppose they're evaluating the following independent projects. Each one of them costs $100 and lasts 1 year. So we're showing you now they're going to take the net present value at 30%. Okay, so for project A, it would come in as 15.38 positive. For project B, it would come in at 0. And take a look at that. The internal rate of return on project A, so what's the actual rate of return on project A from money inside the company, 50%. So the net present value will tend to be positive. When the internal rate of return is above our required rate of return, that's normally what happens. But in B, it equals 30%. So it's at 0 net present value because cost of capital, 30% equals internal rate of return. But then when the internal rate of return is at 10%, notice our net present value is negative. So we would tend not to take on project C because it's not producing a return to at least the cost of our capital or that required rate of return of 30%. So we could see this in a graph. So when you have a project internal rate of return that is less than that required rate of return, you're generally not going to take on that project. So it's just graphically showing that. Okay. So when, and this is now, I like following along with this chapter. Reading through it, I was like, I love this chapter. And so there's so many things I want to make sure I point out to you. On page 360, we were given or assumed risk-free rate, market risk premium, and the beta. But how do we actually go about estimating for these things? So we've talked about the risk-free rate already, or you've read about it in your chapter. And Treasury securities are probably the closest to a risk-free rate where you receiving this interest and there's no risk associated with that particular security. So companies will generally use that for short term, and they'll use a longer term Treasury rate for maturities. What they'll do is they'll say, how long is my project going to be? What is the rate on a Treasury bill that's similar to that length of time? So projects are long-lived, so average period short-term rates need to be used. But as a practical matter, the one-year Treasury bill rate will be assumed as an accurate estimate of short-term rates. So you can look it up. So no one agrees on what that horizon is as far as you should match your project with an actual Treasury security timeline. So basically then we're saying it's a period by period model, but short-term rate or the one-year rate is probably a good risk-free rate. So now we have to, how do we determine market risk premium? Well, there's two methods. The first is historical data. Just go back and look and see, well, what's the normal market risk premium historically? And back in a prior chapter, we did some, chapter 10 showed you those historical rates and items for different types of securities. And it came out to be the market risk premium is about 7%. So that's one way of determining the market risk premium. Now, to determine your overall required rate of return, then you would take your market risk premium times the beta for the stock plus that risk-free rate. Okay, so that's where they get the 12.9 here. They've given this information up above. So pretty straightforward there. Use the historical 7% market risk premium. But another method of determining your market risk premium is use your dividend discount model. If you remember that from a couple chapters ago, and even in this chapter, we took a look at the dividend discount model that said the price of today's stock is the dividend in 1 year divided by the discount rate, so your required rate of return, minus G, growth. Well, we can manipulate that formula then and restate it to determine the required rate of return. And that would be your dividend in 1 year divided by the price today, your dividend yield plus growth. So that's another way of determining your market risk premium. So we can use expert information. These things are projected to calculate these. You don't have to guess at them. And they talk about that on page 361. Finally, beta. How do we estimate beta? So we've talked about beta and how to calculate it. And the formula is given on page 362. Okay. So remember, the beta is the covariance of a security with the market divided by the variance of the market. Okay, so we're not going to go into all the calculation of it, but it's important to remember, well, as we see there, we need to look at a market portfolio. Remember, that is the portfolio of all the assets in the economy. So in practice, a broad stock market index, such as the Standard & Poor's 500, is used to represent the market. Beta is the sensitivity of a stock's return to the return on the market portfolio. And that's what that formula defines, a particular stock's sensitivity to the return to the market return. And there it is again. So some of the problems with this is that betas can vary over time. Sometimes when we're looking at the covariance and measuring it, our sample size may not be large enough or small enough to really determine a true beta. And betas are influenced by changing financial leverage and business risk, which we're going to talk about. So how do we solve these problems? Well, problems 1 and 2 can be moderated by more sophisticated statistical techniques. So really, take a look at how your information is changing over time and make sure you have a proper sample size. Problem 3 can be lessened by adjusting for changes in business and financial risk. So we could look at average beta estimates of comparable firms in the industry. If you take a look on page 363, this is a figure here for 4 different companies. And it's looking at the company's return versus the S&P 500 return. And the beta, which is that slope of the line, because regression analysis is what we're actually creating there, and fitting a line between those data points. So the lesser the slope or beta, the less risk there is. So you can see there, Next Era Energy has much smaller slope because the line doesn't change that much as compared to CarMax. Okay, so that's what our beta is. So again, we take our monthly returns in this figure on page 12.3 for these 3 large companies and plot them against the S&P 500 return. And that will define our beta. Now, do beta stay stable like we have here? No. Okay. But they generally will stay stable if the company operates in the same industry. So if you have 2 or 3 different industries within your firm, it could be hard to estimate your beta. But if you're just an airline, it could be, you can estimate your beta, but you have to be careful because it may change if you change a product line, you change your technology, there's deregulation, or there's changes in what we say financial leverage. So we're not saying it's always going to stay stable, especially if you don't operate in the same industry. But if you do, chances are it may, unless you have a major change in one of these areas. So because of that, can you really estimate your own beta individually? And so there's arguments that say, hey, no, use the firm's beta for the whole industry. Let's take a look at the betas of all the companies in our industry. So if you believe that the operations of the firm are similar to the operations of the rest of the industry, just use your industry beta. If you believe that the operations of the firm are fundamentally different than the rest, you should use the firm's beta. So that's how people approach the beta. If you take a look on page 365, remember, beta is important in determining our required rate of return. So it's important we estimate it properly. Assume a risk-free rate of 2.4% and a risk premium of 7. Fiserv might estimate its cost of equity as, so Fiserv has a beta of 0.76, the risk-free rate plus 0.76 times the market risk premium, or 7.72. However, if Fiserv believe the industry beta has less estimation error than their own, it could estimate its cost of equity as using the industry's, which is the very last one, 1.04. They just take an average, basically. So take the risk-free rate plus the industry beta times the market risk premium. So that's a big difference, 9.65 to 7.72. So if you go to the paragraph below, it says, there is no formula for selecting the right beta. If you believe the operations of the firm are similar to the operations of the industry, use the industry beta, like we said here. If not, use the firm's beta. Now, what do we use to really determine our beta? Okay, so they tell us the betas here, but they don't tell us where they come from. So there's 3 major items. Business risk, which includes cyclical revenues and operating leverage. So let's take a few minutes and you could grab your book and we'll really talk about this. And that is how dramatically do your revenues change during the different cycles of your business, not seasonal cycles like fall and winter, but brand new, your expanding and contraction phases. So depending on the type of business or industry you're operating in, your risk associated with changes in revenue from expansion or contraction can be significantly more than others. You need to account for that, and that becomes part of your beta. So, as it says in the very last sentence, because beta measures the responsiveness of stocks' return to the market return, high cyclical stocks that really go high up in revenue or low in revenue, depending on the cycle of the company, will have high betas because there's a lot of risk associated with it. Operating leverage. So what kind of effect on beta does your fixed costs and variable costs have? For instance, fixed costs you have to pay, okay, no matter what. So there's a lot of risk when you have to pay those, especially if you don't have the sales revenue to cover them. Where variable costs have, and when they're higher than fixed costs, they move with sales, so there's not as much risk associated with them. So, as the book says, with high fixed costs and low variable costs, you generally have a higher operating leverage, therefore a higher beta. So the effects on beta there's an effect on the beta because of the way your costs are designed. Finally, financial leverage. So financial leverage is the extent which you rely on debt, okay, within your capital structure. So do you have debt and equity, just equity? So the combination of that. And that's a great, so there's the cyclical. Sorry, I wasn't even thinking that this was here. There's your operating leverage. Right? But let's get to our financial leverage. So financial leverage is the sensitivity to a firm's fixed cost of financing. So what we do is we take a look at the relationship between the betas of the firm's debt, equity, and assets. And this is defined as you can see there. So the beta of an asset equals the percentage of debt. So the total amount percentage-wise that you finance the company with debt times its debt beta plus the percentage of the company that's financed with equity times the equity beta. So those two added together will be the overall asset beta. So financial leverage always increases the equity beta relative to the asset beta. Okay, so let's take a look. Let's take a look at an example. Consider Grand Sport, which is currently all equity financed and has a beta of 0.9. The firm has decided to lever up to a capital structure of 1 part debt to 1 part equity. So now they're like on a 50-50. Since the firm will remain in the same industry, its asset beta should remain 0.9. So that's not going to change. However, assuming a 0 beta for its debt, its equity beta would become twice as large. Okay, so it normally has a 0.9 equity. Since it's in the same industry, remains in the same industry, its asset beta will also remain the same. Now let's take a look. 0.9 equals 1 over 2 times B. So 1 over 2 is 1/2 B. So if we're trying to find B or beta of equity, well, 1/2, move it to the other side. Now you got to multiply it. Now the equity beta, because it's financed, because the debt has no beta, no risk, is 1.8. So the equity risk or equity beta increases. So we're showing you the relationship there. So those are our major components of beta. That's how we decide, or that's how it comes about. So the sensitivity that revenues have due to their change, the risk of change because of the type of company it is, the risk and sensitivity because of fixed costs and variable costs, and then the sensitivity due to the amount of debt to equity. Okay, so just some background on that. All right, so now we're going to go to section 12.5, where we're going to talk about the dividend discount model. So the dividend discount model is an alternative to using the capital asset pricing model for calculating a firm's cost of equity. So the DDM and CAPM are internally consistent, but academics generally favors the CAPM, and companies seem to use it more. So this may be due to the measurement error associated with estimating company growth. So we see that formula again at the bottom of page 367. Now, I'd like you to go to page 368 though, before we move on. So what this is saying is that if we want to determine a required rate of return, we could take the dividend at the end of year one divided by the price today plus the growth. The dividend yield is very easy to find. Usually experts are doing that, showing us that. And we can calculate a firm's growth. You can calculate it from past data, or you can use your growth formula, which would be your retention ratio. So that's, remember, the amount of profits you're keeping in the business times your return on equity. Okay, so, or that's how you could predict growth, or you could predict growth for this purposes of this method by looking at what the experts say about your potential for growth. Okay, so you can use it. It's just what we're saying here is, and where you can get that information from, it's not hard to. It's just that generally people rely more on the capital asset pricing model to get that required rate of return. On page 369 is this picture. And it basically is saying, if a firm uses one discount rate for all projects, it may over time increase the risk of the firm while decreasing its value. So it's very, very important that we just don't say, oh, we got a rate, we got a required rate of return, we're going to use that forever. Now, we have to make sure we're updating that. Also, what's very important is sometimes we may need to use just a required rate of return on a project for some, and maybe a required rate of return because of the company as a whole. So that's what this picture is depicting. So again, it says a single cost of capital for all projects in a firm as indicated by the horizontal line. So our line right here, the hurdle rate, which is the picture there, that's where we always want to be. Projects with high risk should be discounted at high rates, not at a hurdle rate, because if there's a lot of risk, you want to make sure you're accounting for that. So by using the firm's cost of capital, the firm is likely to accept too many high risk projects. So projects that fall up here, that if properly discounted, would have a negative net present value. And vice versa. We may end up rejecting projects because they have, they're below the hurdle rate, but would end up having a high net present value because we should have used a lower rate to determine the net present value. So that's what this is trying to depict here. Suppose the conglomerate company has a cost of capital based on the capital asset pricing model, 17%. The risk-free rate is 4%. The market premium is 10%, and the firm's beta is 1.3. Okay, so 4% risk-free rate times the beta plus the market premium, 1.3 times 10 plus 4, 17%. The company has, this is their investment projects, 1/3 automotive retailer, the beta is 2. There's 1/3 computer hard drive manufacturer. You know, this is like the different projects within this company with a beta of 1.3. A 1/3 electric utility, beta of 0.6. So if we add the 2 to the 1.3 to the 6, divide that by 3, the average beta of the assets is 1.3. So when evaluating a new electrical generation investment, what is the cost of capital that should be used? 17%. Well, investment, let's see. What happened? Hold on. Let me go back. Stop recording a second and make sure we're all on the same page. Okay, so taking the information from that example, we would require rate of return. The risk-free rate is 4%. For electrical division, it's a 0.6 beta times the market risk premium, which would be the 14% minus 4% or 10%. So 10 times 0.6, which would be 6 plus 4%. So 10%. So 10% is the cost of capital for an electrical generation, because we would go to that electrical division and use that beta for a project. So we have to be careful of that. Page 370. Just want to make sure I'm not forgetting anything. Okay. And I want to bring this to your attention. It's in the middle of the page, and it says, analysts often talk about identifying pure plays or other companies that specialize only in projects similar to the project your firm is considering. So that could be one way you find your beta for a project. Another way, and this is in your next paragraph, even if all companies in an industry are pure plays, the beta of a new project may be greater than the beta of existing firms, because a new project is likely to be particularly responsive to economy-wide movements. Okay. However, all you have to do is make a slight adjustment. So you should assign a little higher beta to that kind of project. Another problem that you need to keep into consideration is when there's rare projects in its own industry. Okay, so you could probably reasonably estimate, but you need to adjust that beta, especially if you take into account those other factors that affect the beta. So we're just telling you the pros and cons of coming up with a division beta for a project in that division versus an overall beta for the company, and things you need to look at. Now, not only do we have the cost of equity as in common stock, but we also have the cost of debt and preferred stock if that's being used to finance the company. And I already saw some people posted, I'm not getting this after-tax stuff. So you have to remember, when it comes to debt, the major cost is interest. You got to pay interest when you borrow money. So interest rate required on the new debt issuance, the yield to maturity, must be adjusted for the tax savings, because you get to deduct that interest on your tax return. So I'm not even going to go forward yet. Let's go over to page 371. So what this is saying is, when you're trying to determine the cost of debt, figure out your interest. In this case, this company has borrowed $100,000 and it has a 7.9% interest rate. So if we look at that, then the interest will be 100 times, 0.079. 100 times 0.079, $7.90, right? That's how you can look at it, $7.90. So they get to deduct that $7.90 on their tax return. So that means they'll save paying taxes. So we multiply that by the tax rate, 0.21. So this company will save $1.66 in taxes. Oh, I'm sorry, I'm reading this wrong. Sorry. Let me go back. Sorry about that. I'm reading the after-tax cost of debt percentage instead of the actual interest rate. Go back up. Instead, we have here the unlevered company has $100 of debt with an interest rate of 10% on the debt. So if you're thinking I'm kind of crazy, sorry, I read it wrong. So that means each year they'll have to pay interest of $10, which will be deducted on the tax return. $10 times 21% is a $2.10 tax savings. So that means although they pay $10, they save $2.10 in taxes. So they really are only paying $7.90 overall for that debt. So to calculate that, the after-tax cost of debt then could be 1 minus the tax rate. So whatever the corporate tax rate is, which is currently at 21%, times the borrowing rate. So 10% times 0.79 will give us 7.9%. So that's how we calculate the after-tax cost of debt, 7.9% of the debt. Preferred stock also has a cost. So remember, preferred stock is a perpetuity. So its price is equal to the amount of dividends at the current required return. So we could rearrange that formula we once had to get the required rate of return or cost of capital for preferred stock by taking the amount of the dividend divided by, in a year, divided by the price today. Okay, so the example on page 372 shows us if you take the preferred stock for Polytech, which pays a dividend of $1.50 per year, divided by the current market price of $17.16, the cost of capital or required rate of return for preferred stock is 8.7%. So we showed you how to determine the cost of equity when it's common stock, basically, the cost of debt, and the cost of preferred stock. So now we can put that all together and do a comprehensive weighted average cost of capital. The way we do that is we take the equity of the firm divided by equity plus debt times the required rate of return on the equity, plus the debt of the firm divided by the total equity and debt of the firm. So what percentage is financed by the debt times that required rate of return for the debt. Okay. And if you didn't already account for the taxes, you have to account for the taxes. Okay. And then you can see that there. So we're going to look at an example on page 373. So you can see that formula in action. Consider a firm whose debt has a market value of 40 million and whose stock has a market value of 60 million. 3 million shares outstanding stock, each selling for $20 a share. The firm pays a 5% rate of interest on its new debt and has a beta of 1.41. The corporate tax rate is 21%. Assume that the security market line holds. The risk premium on the market is 9.5%, and the current treasury bill rate is 1%. How do we compute the weighted average cost of all the capital? First of all, we must calculate the after-tax cost of debt. And that will be, take the pre-tax cost of debt, which they say all new debt is 5%, times 1 minus the tax rate. So 5 times 0.79, 3.95% is your after-tax cost of debt. We will calculate the cost of equity, because that's the other part, by taking the risk-free rate, which they give to us as 1%, plus the beta of the firm times the market risk premium, which is given as 9.5%. So multiply those two together, add the 0.01, 14.4%. So once you have your after-tax cost of debt and your cost of equity capital, the next thing you do is compute the proportion of debt and equity from the market values given. So the market value of the debt is 40 million and the market value of the equity is 60 million. So together, the total market value is 100 million. So the ratio of equity will be the 60 divided by 100, or 60%, times the cost of capital, 14.4. Add to that the percent that's financed by debt. Debt, 40, divided by total debt and equity, 100, times the cost of debt. And those two added together will then give us our weighted average cost of capital, which, if we go back to the beginning of chapter 1, remember what weighted average cost of capital is. It's the minimum return a company needs to satisfy everyone who gives them money. So in this case, this company's minimum required rate of return is 10.22%. So this is another estimate. I think this is different than. So it's Eastman. We estimate an equity beta to estimate the cost of equity. We can often estimate the cost of debt by observing the yield to maturity of the firm's debt. Then we need to determine the WACC by weighting these two costs appropriately, like we just did. So if we look at Eastman's beta on Yahoo Finance is 1.81, the risk-free rate is 0.5, and the market risk premium is 7%. The cost of equity is 13.17%. The yield on the company's debt is 3.15, and the firm has a 21% marginal tax rate. So we need to calculate the after-tax cost of debt, 3.15 times 0.79, 2.4885. So now we will 2.4885. Oh, they did it. They're not doing it separate. Okay. So what we'll do is we'll say, okay, what's the equity over equity and debt? Okay, and the debt to value ratio is 29.4. So what that means is the debt to value ratio is 29.4. It means of all of the debt and equity, 29.4% is in debt. So if 100% is both equity and debt represents 29.4, we subtract that from 100%, equity represents 0.706 or 70.6%. So multiply the cost of equity, 13.17, we figured out on the last slide, by the ratio of equity, 70.6% of the firm is financed with equity. then multiply your after-tax cost of debt, which would be the 3.15 times 0.79 times the ratio of debt to total debt and equity, which is given as 29.4. So 10.03 is the overall weighted average cost of capital. It should be used to discount any project where one believes that the project's risk is equal to the risk of the firm as a whole, and the project has the same leverage as the firm as a whole. Now, the next major area they talk about is something called flotation. Flotation costs are the amounts of expenses incurred upon the issue or float of new bonds or stocks. So this means when we sell new stock, it's not for free. We've got to pay some costs associated with it. When we sell new bonds, we have to pay some costs beyond getting the money. So these are considered incremental cash flows of the project. These are costs of the project and should reduce the net present value since they increase the initial project costs. So the amount raised equals your necessary proceeds divided by 1 minus the percentage of flotation costs. So if you take a look on page 381, you have a company here, Triple Day Printing. It's going to do a debt to equity ratio of 100%. It's currently at that. It is considering building a new $500,000 printing plant in Kansas. The plant is going to generate after-tax cash flows of $73,150 per year. The tax rate is 21%, and they have 2 financing options. They could issue new stock. The new stock would cost them 10% of the amount they want to raise. The other, and their required rate of return on the company's new equity is 20%. The other thing they could do is sell 30-year bonds. The issuance cost of these are 2% of the proceeds, and the company can raise new debt at 10%. So what is the net present value of the new printing plant? Well, first, because printing is the company's main line of business, we will use the company's weighted average cost of capital to determine net present value. We'll do that by taking the cost of the equity over the debt. So it would be a 50-50, so 50% times the required rate of return, 20%, since you have 2 choices here, plus 50% times the return on the new debt, so the after-tax return, or the return of 10% times the tax rate will give you your after-tax return. Add those 2 results together. So the weighted average cost is 13.95. Now, let's take into account the flotation first. Because cash flows are $73,150 a year, the present value of the cash flows at 13.95, you use the weighted average cost of capital, okay, will be $524,373. So if we ignore any flotation costs, it would look like we would have a positive net present value. But we do have flotation costs. So we have to factor those into our calculation. And here's how we do it. Because they use equal amounts of debt and equity, the average flotation cost, which is represented down at the bottom of our screen here, FA, equals, okay, the percentage for debt times, percentage investing in equity times the cost of the equity, which is 10%, that's given, plus since it's 50-50, debt and equity, 50% times the cost of debt, which is 2%. So we're looking at a 6% flotation cost. So what does this mean when we're doing our net present value? Keep going. We take the 500,000 times 6%. Okay, $30,000. Or better yet, we could take 500,000 divided by 100% minus the 6% or 0.94. That's a better calculation. And we get what's the actual cost of this project at time zero? $531,915. Since that's an average flotation, we take the cost of the money we have to raise, 500,000, and divide it by 1 minus the flotation cost, which in this case is 6%. So the cost of the project at time zero is 531,915. The present value of the future cash flows is 524,373. So guess what? When we factor in those flotation costs, now we wouldn't take on this project. Okay, so that's another component. So lots of things in this chapter where we first started talking about determining the cost of equity. Remember, required rate of return, cost of capital, discount rate, they all mean the same thing. That's the cost of the equity, which is found by taking your risk-free rate plus your beta times your market risk premium. We talked about how we determine the risk-free rate, what methods we have to choose from to determine the market risk premium, and how we go about estimating beta. What factors affect it? Then we talked about the dividend discount model as an approach to determining required rate of return, but most people use the cost of the CAPM method, okay? We talked about being careful that you don't use the same rate all the time to discount projects, because you might find yourself in a trap of you're accepting things you shouldn't, or you're not accepting things you should. So in this first part of the chapter, we focus purely on financing the company with equity and the things you need to look at. But then as we proceeded, we talked about, well, what if you start financing with debt and equity? So you have to determine the cost of debt. Remember, that's an after-tax number. The cost of preferred stock also needs to be determined if you decide to finance with that. But in our weighted average cost of capital problems, we focused on cost of equity and cost of debt, and how we would determine overall our weighted average cost of capital based on what percentage of the project is being financed with debt, what part is being financed with equity, and their required rate of returns. Okay, then we factored in our flotation costs, and that brings us to the end of the chapter. So hopefully I brought more light onto the material in this chapter. Please continue to post your questions on the discussion board.